Senator and presidential candidate Rand Paul is betting his audit the Fed drum, beating it a little louder. In a Bloomberg View column today, Senator Paul writes, quote, "The Fed is sometimes called the fourth branch of government, even though the Constitution created only 3 branches. Congress is complicit in this concentration of power and should take responsibility for helping the Fed find constructive limits. A more thorough audit would be a good start." So does Senator Paul have a case here? Let's ask Bloomberg Economics editor Michael McKee. Mike, this is completely unrealistic, correct?
Well, it's unrealistic. It's not getting a lot of traction in Congress, but the idea of bashing the Fed does get a lot of traction out on the campaign trail. It's hard to know whether Paul is ignorant or playing on the public's ignorance, because his op-ed sort of wanders around in a lot of different directions to flail away at the Fed. Some of it makes sense, some of it doesn't. He starts off by asking whether the Fed's payments to banks are reasonable and necessary. Well, that's interest on excess reserves. And Congress authorized that in 2008. So he could start with Congress and the question of whether it should be done. Reasonable and necessary gets at the idea of these excess reserves designed to take money out of the economy so we don't get too much inflation. That's a monetary policy call by the Fed. The General Accounting Office probably not qualified to answer that question if Nobel Prize-winning PhD economists can't answer that question.
Do you think he's doing this as a principled call, or is this a saber rattling to get some votes in Iowa?
Well, it's probably a little bit of both, in that he's been calling for this for years, but the reasons behind it don't make a lot of sense. Originally, they were calling for audit the Fed. Well, the Fed is audited. All of its books are audited. But since the balance sheet's gone up so far, we're now around $4 trillion. The calls have gotten louder. The idea that the Fed is manipulating the economy has become more entrenched. As people don't feel better about the economy, they're looking for somebody to blame. And Senator Paul is saying, hey, you could look at the Fed to blame, because they have impose themselves on the economy. And that's where he does make a good point in the op-ed, that the Fed is pretty much the only game in town. They're setting interest rates right now through their purchases. It's hard to tell what the real price of bonds is, and that's something that even the Fed worries about.
Of course, and that's why everybody's worried that if we were to have another crisis, there would be no more levers to pull because rates are already at record lows. Can we connect the dots with the sell-off just for a second, since you're the economics editor and know everything about the Fed? In the broader macro picture, we're all bracing for tightening, trying to figure out whether or not it's going to be September or December. To what extent do you think that the looming rate hike is the catalyst for some of the selling we're seeing in the equity markets, or currency, commodities?
It plays into it, because as you raise interest rates here, it attracts more money into the United States. It attracts hot money out of the emerging markets, and that's a problem. But they're also suffering because many of them are oil exporters, and the price of oil has fallen significantly. A lot of them do a lot of trade with China, and China has revalued its currency. Now, this is an overreaction given the amount of movement in the Chinese currency, but that's what markets do.
But it's also directional, right? I mean,
exactly, and there's a momentum trade here going on. We were talking earlier with McKee Levy from Berenberg Bank, and you're basically saying what markets do is panic first, think later. And that's what we're seeing at the moment. And you just had Scott Wren on saying a couple months from now, things will settle out a little bit.
Ready, fire, aim is the way the market.
Exactly. And the data from what is happening now won't be reflected in the data on September 17th. So the Fed won't be able to say China's hurting the U.S. economy because of this, or oil prices because of that. They'll only be able to theorize. Makes their job a little bit harder.
Although they did say in the minutes that they were waiting to see what the reaction would be in China and the Chinese market even, and we've certainly seen that since those minutes.
The July.
Right.
Well, if the dollar gets stronger, which it did up until about a week ago, the interesting thing about all this is the dollar's not getting stronger in the face of all this. It's sort of being diffused around the world. But if the dollar does get stronger,
Treasury yields are down.
That pushes inflation lower, and that's a problem if you're getting too close to disinflation. But at this point, it's hard to say what it's going to be like in a couple of months.
All right, Mike McKee, Bloomberg Economics editor, thank you so much for your time.